What's up you guys, it's Keith here, and in this video we'll be going over Evergrande, a little bit of the contagion that could occur looking at the main institutions holding either Evergrande the company or the banks that have loaned out billions to the company. And then we're going to look a little bit at the S&P 500, looking at the VIX, seeing that potential significant push to the upside for the VIX we'll talk about later. And then we'll end off this video looking at the US bond market, both in terms of yields and the actual price of the 20-year bond for the United States Treasury. And then we'll also look at the US dollar, looking at the DXY. So let's jump right into it. I'm sure if you are watching this video, you are well aware of the Evergrande situation happening in China. People are even protesting. Really, a lot of news anchors are kind of comparing it to the Lehman Brothers event that happened in the United States back in the global financial crisis. And we do see people rioting and really just being angry. You can see people are saying, return our money, return our money. So it's definitely hitting home there. And this is the company China Evergrande Group. And going into the holders here within Yahoo Finance, we can see a lot of big players are holding this company. Now, it isn't a massive part of their portfolio, but it will create a ripple effect, especially when it's not just a single company that is getting impacted. It's not just the company, but the people supplying the materials, the goods, as well as the banks and other financial institutions that are not going to get paid the full amount that they thought that they were with the amount that they're borrowing, which is pretty crazy. I think it's around like over $300 billion that they have on top of them that is really weighing them down. So looking at the major holders of the actual company Evergrande, we can see number of institutions holding the shares 147, which isn't crazy. Surprisingly, a lot of the shares are held by insiders. We can see around 85%, 84.5%-ish. And then we can see the top mutual fund holders here. We see Vanguard, iShares, we see Schwab, we see Vanguard as well. So definitely a lot of major players that are holding Evergrande. Now, we'll also get into, and this is the Vanguard, which we'll get into next, is this ETF or fund right here. And we can see, obviously it's a massive fund. It is pretty well diversified in things like tech, which is actually not doing fantastic right now in China, but it does have other major holdings for like India and other parts of the South emerging markets really. But we do see banks are also on this ETF. So, you know, China Construction Bank Corp. We'll get into that next, but we do see it's not just the single company that's going to get affected, but it's all the other financial institutions that are not going to get the funds that they were initially promised by the company. And we can see this is the China Construction Bank right here, and we'll get a little bit more into the different banks that have provided credit for Evergrande. But this particular bank, the CCB, the China Construction Bank, was the second largest bank in the world by market cap in 2015, as we can see within this section right here, and it was the sixth largest company in the world. Pretty crazy. And it's not just the CCB that is getting affected. We see other major Evergrande creditors, including the Minsheng Bank. We see like Industrial and Commercial Bank of China. We see, like I said, the China Construction Bank, China Zheshang Bank, and the Bank of China. So we'll get into some of these creditors for Evergrande in the next couple slides here. But it does show it's not a single company. It's not like one small company that's getting affected. It is going to create a ripple effect, and the hot word that a lot of news casters are actually saying is the word contagion. How much contagion is there going to be for this certain event? Is it going to spread across all of Southeast Asia? Is it going to go global? That's the big question. And another question is obviously, are they going to get bailed out by the government? And that's going to be a big question that is not answered yet. I have seen some articles that state, yes, they are going to get bailed out, but we haven't seen that confirmation yet, so we can't make that assumption. So this is the China Minsheng Bank, another large bank that has been a creditor for the Evergrande company. We can see its holders here. Not a lot held by insiders, only 28%, and a lot of shares in terms of percentage are held by institutions. Around 200 institutions are currently holding this right now, and we see similar mutual funds are holding this bank. So you see a very similar type of investor or type of fund hold obviously because it's in the emerging markets, but you see it's all tied together. You see the financial system, you see the real estate system, because China has such a large portion of its GDP in the real estate sector. It's all intertwined. The finance sector as well as the real estate, especially in China, are going to move in a positive correlated manner in my view. And we can see with this bank, we see Vanguard, iShares, we see Fidelity as well. We also see Charles Schwab in there as well. So a lot of exposure, even from global investors, not just looking at Chinese financial institutions that are holding these banking companies here. So another one we can see right here for the holders, CITIC Bank, I believe is how you say it. I don't exactly know. But we can see not as large in terms of the percentage held by institutions, but same people almost every single time, right? It makes sense because it's an emerging fund, just in terms of the exposure investors are looking to have when investing in this fund. But you see the same things: iShares, Schwab, Vanguard. So these funds are going to take a big hit because it's not just Evergrande that is going to get affected by it, but it's the creditors, it is the manufacturers that are being able to sell services or products, goods to this company and other real estate developers here. And another one, Industrial and Commercial Bank of China. We can see a significant portion of this company is held by institutions, and same thing, we see iShares, Vanguard. Don't see Schwab on this list, but they could just be a minor instead of a major holder. And then the last one we'll get into, we don't see any holders, but you do see that still a lot of financial institutions are holding the Zheshang Bank as well. So it's pretty unbelievable. And then here's a little bit of information here that I found just pretty crazy. The liabilities for the company Evergrande equals to 2% of the country's GDP, which is just absolutely insane. I just find that crazy in terms of a number and a statistic. And the company's bank exposure is recently been leaked in 2020 in a document, and a lot of people wrote it off, but it did show the liabilities extending to more than 128 banks, over 121 non-banking institutions. So if it does get severe in terms of the impact it has, the contagion is significant. It's not just in China, it is global. A lot of funds are investing in China just as a whole, not just specifically the real estate development sector. So I do think if it does default, if it does start to create a chain reaction, that it will create a lot of fear, uncertainty, doubt in the market. We've already seen that within the US stock market. We'll take a look at that right now. But it's definitely something to keep an eye on. So we'll now take a look at the S&P. We're not going to dive really deep into it, just talking about some major levels that we currently see within the market. So let's go to the daily chart and just talk about what we're currently seeing right now. So we'll get our SNP, and then we'll have a little quick draw here, discuss what's currently happening. And what we've seen really since the start of the year is just dip buying. Every single time we've seen a dip, as we can see, we just get dip buyers, buy the dip mentality coming in every single time, especially on this nice ascending zone, as we can see right here, holding as a nice level of support. We have broken that zone. We talked about that zone of confluence, which was the horizontal level as a previous level of resistance, turning into a new level of support that failed along with that ascending zone, and that was our zone of confluence. So at that point, we were definitely worried that there was going to be a little bit of a sell-off, which was right there. We did see that move to the downside, and we are creating a series of lower lows at this point, because this was the first low, this was a lower low, and now we're getting a lower low. So we can connect the lower lows and we get a nice little descending zone right there. And we also see a well-structured descent. So then we can create our descending zone, and it does look like we are potentially squeezing. So we have two possible scenarios here. We have the first option is if we do break this major level of support right here, we could potentially create a head and shoulders, and the around 4,400 zone is going to be the neckline. We can see this is the first shoulder. We got the nice big head. And then if we do retest that zone, that's going to be forming our major head and shoulders, and that's not going to be looking good for the overall market. So that's a potential scenario if the Evergrande situation does spiral out of control, and if there's a lot of contagion, there's a lot of fear, a lot of uncertainty in the financial markets. Another option is if it does default, things don't go nearly as bad as what a lot of investors are thinking, and it kind of blows over and nothing absolutely crazy happens from it, in the West at least, then I'm assuming that we're going to get a nice structured squeeze similar to this, and then we'll get deeper into the squeeze, and then we're going to continue on looking for risk on asset exposure. But as of right now, it is looking a little bit worrying for even the US markets here after breaking this key level of confluence. We can see right around there. Now we're pushing to the downside, and we're making lower lows and lower highs, and the momentum is back in the consolidation phase, which is not necessarily a bad thing because we just had such a strong run up, but it is a point where there is probably not going to be a lot of speculation happening. I think the overall cryptocurrency market is going to be consolidating for a little bit because of this uncertainty within the market. So that's my current outlook within the S&P. We can take a little bit of a zoom in just to take a look at what we're currently seeing. And on a smaller time frame, on a 6-hour, look at these nice, well-structured, decent, descending lower lows and lower highs, especially with the well-respected resistance zone capping those lower highs. So it's looking well-respected overall, and what I'm looking for, if we get the brush here, is to see lots of buy pressure somewhere around there. So the price has been consolidating, and then just a big dump down, and then at this point we're seeing if the buyers are able to hold this major level of support, because if that's the case, what we're looking for is a big dump down and then some consolidation, maybe like a double bottom or some formation and consolidation at the low at 4,300, and then we're looking to see this descending zone right there break, and then this is the bottoming formation. You know, we could see a nice bottoming similar to this, and then once it breaks this zone here, you get the horizontal level of resistance to break along with the rounded bottom, similar to what we got in gold, where we got that nice big move to the upside, and then you got like a very slow consolidation, and then once it broke that major level, it started to really rally again, and this is on a larger time frame. So I think that if we do start to see a nice bottoming at around that $4,300 level, that could be a nice bottom, and then once we squeeze out of this key level of resistance, that could create the momentum for us to really start to charge to the upside again. But like I said, the news is going to be pretty impactful, and we also have the FOMC meeting minutes that we do have to take into consideration in the near future for this month of September. So that's going to be my view of the S&P. We won't really get into the volatility. Actually, we'll take a look at the Volatility Index very quickly because I do think it's really important. It is looking like we could see a potential breakout here. Obviously, this isn't going to be exactly here. We could make it a little bit wider, but what we're really looking for, let's get our snip really quickly, is to see if volatility is expanding. If it is, obviously that's a pretty bearish sign, a lot of fear in the markets, because we have seen this squeeze right here slightly pushed to the upside. I'm not really concerned because we can see that this major level of support is now acting as a major level of resistance. So I am still viewing this as a consolidation down. If we start to see like quite a bit of a rally above the $23, $24 zone, that would definitely be a little bit worrying for me in terms of the more traditional legacy markets, because that would indicate more fear coming in, and that would obviously drive the US markets down, and crypto at this point is still positively correlated to risk on asset appreciation. So I don't think that it's going to be good for crypto when you do see market sell-offs in the traditional market sense, like looking at the S&P or the NASDAQ or Dow Jones, anything like that. So as of right now, we're still holding above this in my view, although we are poking just a little bit above it. Ideally, we want to see that continuation where we're seeing a little bit of a squeeze right here. And if we are going to see the market move higher and fear not set in, we are probably going to be seeing the volatility just squeeze, and then just fall to the downside, maybe even potentially making a new low from the lower low that we can see right here, which would be ideal. Now, if we do get a lot of fear, a lot of uncertainty, and the contagion does spread aggressively throughout the globe, then we will see this absolutely skyrocket, and that's going to be a pretty bearish situation for really the entire market. Everything that is a risk on asset, I'm talking like all alts, even Bitcoin, I don't think is classified as a risk off asset yet. Stock markets will be falling, even like NFTs and stuff I think will be a little bit in a lull, but that's definitely not yet happening, so we don't want to speculate that it will, but just something to keep into consideration and another tool to use to give you a little bit more confirmation when looking at the more traditional markets and coming to a conclusion, does it look bearish or bullish? So that's going to be the more traditional markets, and then we're going to end off the video looking at the US bond market. So we're going to be looking at both the actual price of the bond as well as the yield on the 20-year government bonds there. And then we're going to end off the video looking at the US dollar, which is the DXY, which is basically like a comparison of the US dollar against the other major fiat currencies in the world, mainly euro. I believe euro is over 50% of the composition of the DXY when you're comparing the US dollar against something. So basically the euro USD chart opposite is kind of what this looks like. Let's jump right into the US bond market. This is the actual value of the bonds, not the yield. So ideally what we're looking for is to have less capital flowing into US bonds, because US bonds is primarily for people who are worried about a sell-off, a dump in the traditional markets. So it's where investors turn to for safety during times of fear. So really, I did not want to see the price go above this point, because if we're looking at it from like a pretty large time frame, we can draw this zone here, we can draw this zone here. If you haven't kind of already noticed, we can draw this nice head and shoulders right here, left shoulder, and then we see the head right here, kind of a complex head, and then you see the right shoulder, and then that's our nice formation of the head and shoulders. So I really do not want to see the price go above that 150 zone of resistance. It is consolidating, forming a nice either ascending or symmetrical triangle where you're seeing a key level of higher lows there, but we haven't seen that break yet. So we're really looking to see this break down and start to move to the downside here. If it doesn't, that would mean that there's more investors worried about the financial markets, seeking to be safe and just really not get much of a return, but at least hold their value compared to being in more risky traditional markets like the S&P or something that could dump aggressively. So like look at during the COVID crash, when even gold and silver absolutely dumped, all crypto fell, stocks across the board were just absolutely dumping. We see the value of the bonds absolutely spike. And this is what you see when you see lots of uncertainty and fear within the market, is you see people rushing into bonds, and you see the US dollar overtake a lot of currencies and get a lot of buy pressure, because as the world reserve currency, a lot of people are looking to the US dollar for that safe haven characteristic or functionality there. So not really going to get too much into a smaller time frame here. We see that nice contraction. It did look like it broke a little bit right there, break a little bit, but this is that major level of ascending zone, and then we're looking to really not see the price push above this around 150 to 151 range. So ideally we're looking to see the price continue and then start to fail, and then once it starts to break this nice ascending zone, that's going to be the trigger, along with the yield forming a similar sort of structure, to assume that we are going to continue the risk on sentiment. But if it does continue, if this structure does continue and then actually break to the upside and break like the 152 range and then continue its momentum upwards, that would mean that there are more investors looking or already purchasing US bonds, creating, in my view, increased level of uncertainty for the future on a global scale. So definitely something to really keep an eye on. I think it's going to be really important to understand where this is going, because you know, the bond market is absolutely massive. I don't exactly know what the market cap is, but it is significant. Now this is the actual yield of that 20-year government bond, and what we're looking for is a negative correlation between the value of the bond and the yield. So if we're looking to see the actual value of the bond go down, we're looking to see the yield go up. So what we're looking for is a nice bottoming structure for the yield, and then we're ideally looking to see it start to rally back up and continue its initial momentum we saw back in the later half of the summer of 2020 there, where we got a big rally up all the way from like 1% all the way up to around 2.3% in terms of the yield, and now we're sitting around 1.8. Ideally, we're looking for that nice rounded bottom where you already see that strong level of resistance right there, and we're looking to see that nice rounded bottom where initially we were looking at this as an ascending zone. It's already kind of broken, but it would be nice to see like a rounded bottom like that. And then once you get a break of that key level of resistance, you're looking to really start to see that yield go higher, bond values going down, and the overall risk on sentiment continuing. And the last thing we're going to get into is the US dollar, the finale of the charts here. I don't think this is a perfect representation of the strength or weakness of the dollar because you're just comparing it to other fiat currencies. So I think a really good thing to also look at is things like gold and silver and the S&P, just having a better understanding of the global markets instead of just looking at this one chart to understand the entire US dollar's strength or weakness. But we can see it is really pressing up against this previous level of resistance right here. It is squeezing because we were able to make a higher low, as we can see, and we can draw our little midpoint right here. And then we'll talk about it using our snip to have a better understanding of what's going on. So on a larger time frame, this is a massive double top. So we see like a huge first top, and then we see a second top, and now we're like right at this major level of support, and we're squeezing like basically just like so at the bottom of this double top formation. So this major level right here is basically this zone right here. So what we're looking for ideally is to see weakness in the world reserve currency, because that's where people turn to in times of fear, uncertainty in the markets. So we're looking to see more speculation and a continuation of what's been happening since really soon after the start of the COVID crash, because since then we've seen bond values go down, the US dollar go down, and yields rise, other than what we've seen like in the recent time frames where there has been a little bit of fear and uncertainty setting in. But ideally we're looking to see this resistance continue to hold the price down. We got a level of confluence there where there is a lot of sell pressure. And ideally we're looking to see this ascending zone break. We're looking to see the price kind of continue to fall and then make its way back down to this ascending zone, where we're going to continue the contraction of the US dollar. And obviously on a longer time frame, we're looking to see this break, move to the downside, and then break this 89 level of support, because this is such a strong level for the US dollar. So that's the ideal scenario, but there is another situation that could arise if this is the bottom, because if we take a zoom out, we have seen that symmetrical triangles have been bottom formations for the DXY in prior times, because this is another bottom. We see a massive sell-off all the way from like 2001 to 2007, and look at this well-defined structure that kind of looks very similar to the one that we're currently seeing, like so. So this is a symmetrical triangle bottoming formation that was able to recover the price and bring it back up to its major bullish push that we saw from 2014 to 2015, and it looks like it's forming something similar right now. We've already seen a symmetrical triangle formation occur for this asset in this market. So if we are going to be able to see a little bit of repetition, you know, charts don't often repeat, but they often rhyme. So this is a similar type of formation, so we have to keep a pretty good eye out. But the major level that I'm personally looking at is going to be this zone right here at around 93, because it was a key level of resistance, turned into a new it was a previous level of support, turned into a new resistance, and we're still currently at there right now, just pressing up, squeezing against it, but we haven't seen a confirmation and a break just yet. So as of right now, we are at a pivotal point in the market where there is some news coming in from China that is creating uncertainty, and the bond markets and the currency markets are at key levels of inflection that could really go either way depending on how aggressive the fall of Evergrande is and how much contagion there is for that particular asset within the financial space globally. So thank you very much for tuning in. It was a little bit different of an episode. I want to bring more news into our videos instead of just talking about charts. If you thought this was useful, educational, entertaining, it would mean a lot if you do give it a thumbs up and subscribe to let us know that you'd like to watch more videos like this and that we should continue making them. So thank you very much for tuning in. Really appreciate it. And until next time, have a good one.